Welcome back to Are You Smarter Than a Libertarian? I'm Jeff, your host. And I'm going to ask you something. If worker co ops are really the future of business, as many leftists like to say, why don't we see them running the world's biggest companies? Where's the worker owned Amazon or the employee run Tesla? On paper, cooperatives sound amazing. Fair pay, democratic decision making, and shared ownership. But when you drop them into reality of a free market system, things get messy. Today we're going to break down why co-ops struggle to scale, what the evidence shows, and why capitalism keeps leaving them in the dust. Let's get into it. The first problem, the capital problem. At the core, cooperatives have what economists call a system mismatch with capital finances. Stock markets reward investors with control and liquidity. You buy shares, you get votes, and you can sell your stake. In co-op, ownership is inalienable and tied to working in the firm. That creates what's called a horizon problem. Workers think in short term. They want higher wages now because any long-term reinvestment will benefit future members and not them. Instead of plowing profits back into growth, they cash out. That kills investor interest because venture capitalists and banks want collateral, control, and high returns. And co-ops structurally resist that. The result is chronic undercapitalization. The average U.S. worker co-op has just 11 employees. Meanwhile, capitalist firms leverage billions from equity markets. Even when co-ops do scale up, like the plywood cooperative in the Pacific Northwest, they match capitalist productivity but struggle to accumulate capital to grow their business. They pile on debt and become fragile when the economy has a downturn. Economic simulations back this up. In a cooperative economy, the capital stock grows slower, and output per worker is only about 73 to 80% of what capitalist system generates. That gap is the funding chokehold. Now, let's talk about decision making. We have decision making gridlock. Now, let's talk the governance of a co-op versus the governance of a corporation. Democracy in co-ops builds commitment, but it also creates a collective action problem. Free riding, endless debates, and voting holds up and slows down everything. In theory, this creates what's called a static inefficiency. Co-ops deliberately stay smaller to keep decision-making manageable, but that means they miss out on economic scale such as bulk buying, specialization, and rapid adaptation. Empirically, in Uruguay, studies show high talent workers leave co ops during good job markets because bureaucratic processes frustrate them. In New York City's small co op scene, members complain about protracted meetings and consensus fatigue. That keeps co ops stuck in a niche like home care and food retail while capitalist firms dominate the global supply chain. Zoran Mandami ain't going to change that. Hierarchies may not be warm and fuzzy, but they are efficient and they've existed throughout history. CEOs can pivot overnight. Co-ops can argue for weeks or months. And in competitive markets, slow movers get crushed like the bug on the sidewalk. The third one, misaligned incentives and worker risk aversion. And here's the kicker. Co-op members wear two hats, workers and owners. That creates conflicting incentives. Do they maximize wages and jobs or profit and growth? In practice, wages and jobs usually win. That makes co-ops risk averse. During recession, they cut wages instead of jobs. That helps survival, but deters bold investments like funding in new technology or risky R&D. And the big talent, the engineers, innovators, and risk takers, they gravitate towards capitalist firms offering equity upside, which is huge. Case in point, failed food co-ops in the US. These co-ops often collapse because members prioritize equal pay, and short-term survival over strategic cash reserves. In a free market, that is suicide. Capitalist firms align incentives through stock options and bonuses. They get employees chasing upside, not protecting the downside. That is why they can scale. And that's what everything is about scaling. Now let's go with why large co-ops are very rare. And here's a case study we're going to get into. Here's the reality. The scarcity of big co-ops is not an accident. It is a market outcome. Even in co-op friendly environments like Italy, where co-ops are 10 times more common than in France, they cluster in low capital sectors. They survive, but they do not dominate. Take Mondragon in Spain, the poster child of cooperative success. Founded in 1956, it built its own banking and education system, scaling to 80,000 workers across 81 co-ops. Impressive, right? But globalization exposed cracks. International subsidiaries now employ up to 40% non-member workers, creating a two-tiered system. And when their appliance giant Fager collapsed in 2013 with 5,600 workers, it was due to overexpansion through debt, slow decision-making, and a refusal to lay off members. Other co-ops had to bail them out. Even U.S. plywood co-ops, once market leaders, declined because they could not attract modernization capital. And Argentina's recovered factories showed the same pattern. Short-term solidarity works, but scaling cracks them open like an egg. And you all have to have some scrambled eggs in your life. Now, here's some closing thoughts. So, here's the verdict. Worker co-ops are not bad. They provide equity, stability, and fairness. But in a free market where efficiency, capital mobility, and risk-taking are rewarded, they hit structural roadblocks. Capitalist firms thrive because they can centralize authority, attract investors, and align risk with reward. Co-ops thrive in niches or with heavy subsidies. I like government handouts, although we do have crony capitalism in this country. But rarely do they scale. And when they try, they often degenerate by adapting hierarchical or capitalist features to survive. The free market does not kill co-ops. It just exposes their weakness, and until co-ops solve these structural contradictions, capitalist firms will continue to dominate global economies. That's it for today's breakdown. Workers' co-ops are inspiring, but no match for capitalism in a competitive free market. Stick around because we're going to unpack another theory in the next episode. It sounds good, but it crumbles in practice. I'm Jeff. Until next time, stay free, stay informed, stay accountable. Thank you for watching. Please like, comment, subscribe, and share, and follow on all platforms.